Hey, welcome back, options traders. So what is VOMMA portfolio risk? Well, this is an extension of a recently posted video where I was talking about VOMMA in general. But once you understand VOMMA, you'll have a better appreciation why you can get some unwanted risks that can creep up into places you would never think to look. So what is that and how does it happen? Well, as always, please be sure to click like and subscribe. It's very much appreciated and definitely helps to promote the channel. So a quick recap on VOMMA. What is it? Well, recall that it's one of our, what we might call a second tier Greek. And by second tier, it doesn't really mean that it's less important. It just means that it's not in that main category of delta, gamma, theta, vega, rho. It's used more for professional trading, or at least for more complicated positions. And what VOMMA shows is your acceleration of vega. Remember that vega shows the option sensitivity to changes in volatility. Well, it turns out, because of VOMMA, shorter dated options accelerate your vega more so than longer dated options. So let's take a look at a graph of what this might look like. So here we have a chart with volatility across the horizontal. This is increasing volatility this way. On the vertical, we have vega, different vega values. And the blue line is an at-the-money $100 call. And the red line is an out-of-the-money 120 strike call. And look at the difference. Let's start with the at-the-money. It's, for the most part, a flat line. It definitely does actually start to taper off as volatility increases, which kind of catches a lot of traders by surprise. They've all heard that longer dated options have more vega, so you would certainly think as volatility increases that it would just continue to push up those option prices, and it just doesn't. Over here at the far left side of the graph, it's about 40 vega. On the right, it's about 35. So it actually just sits flat through the lower stages and then begins to gradually taper. But look at the out of the monies. You start from dead flat and then go like a rocket ship up through here. Now eventually you will reach a point where it starts to flatten and then eventually also begins to taper. But the thing to understand is that if you have a position that gets caught in this acceleration curve right through here, you get volatility moving from 10 to 20, 30, 40%. You can get very large accelerations in your vega, and that means that those positions, if they're short positions, are going against you much harder than the long positions are moving for you, even though your longer dated options actually have more vega in total. And that can happen because of VOMMA. So here's what you have to be careful of is the overall portfolio vega, or sometimes just a single position vega. And what I mean by this is that your broker's platform will generally show one vega number per ticker symbol, or maybe for the entire portfolio. And this can be very misleading. So for example, maybe you own some leaps options and some short-term options. But these short-term options, let's say, are short. You've purchased these leaps and you've shorted these short terms, and yet it still might show a positive vega. Why? Because longer dated options have so much more vega in general, but they don't accelerate to the same degree. And this is where the risk comes in. So if volatility rises, you might actually lose money, even though your broker's platform looked like it was saying the opposite. So for example, let's take a look at a couple of positions. Let's say that you own a 180-day $100 call priced at $8.38. That's at 20% volatility, and the total vega is 0.2786. Now at the same time, you're short 3 of these 30-day 110 strikes, and they have a total value of $1.80. So they're trading for 60 cents each, but $1.80 for the package of 3. That's also at 20% volatility. The total vega for all 3 is 0.1947. But remember, that's a negative to you. So the spread between these two positions, let's say, comes in at $6.58. That's just $8.38 minus $1.80. But this doesn't necessarily mean that you're short options or that you have naked options. Maybe you're long one of these leaps and short one of these, as part of a diagonal spread. And then maybe you've got the remaining 2 sold against stock. So it doesn't necessarily mean that you've got naked options out there, although the math would still work out the same. But this is where a lot of times traders say, well, I don't have any naked positions, and if I look at my broker's platform, it shows the overall Vega is 0.0839. That's just 0.2786 minus 0.1947. So they're thinking, hey, this is great. If volatility rises, I'm actually going to show an increase in the value of my positions. And with the recent volatility, they're thinking, oh, I've got this little safety net in my corner. Well, let's go check and see if that's true. So we make volatility rise to 40% on both positions, and the short 3 options have now gone up to a value of $5.40 and a Vega of 0.2733. But look at your long. Vega is still about the same, actually dropped off a little bit from 27.86 to 27.74. And it increased from 8.38 to 11.16. But take a look at how much more in percentage terms the short options accelerated. And so now the spread between them, if you look at 11.16 minus 5.40, is 5.76. So you've fallen from 6.58 to 5.76 on your options, even though it looked like you should be increasing. Now we could create an even more exaggerated position by understanding that the shorter dated options usually have much higher volatilities than the longer dated options. So in these cases, I made them both priced at 20% and I made them both priced at 40% down here. But if market volatility were really rising, you might see that this bumps up from 20 to 30 and this might go from 20 to 50. And that's only going to push this into even bigger losses. And so the main thing to understand is that this is why it's so important to understand your options theory, your strategies, your hedges, rolls, and morphs. Because really all of your traders are acting on, reasonably speaking, the same information. Everybody's got access to the same websites and CNBC and the same information. But where the game is played, where the money is made, is from how you react to that information and how you structure your portfolios. And so I hope this helps you to see that if you don't understand how all of these positions relate to each other, that you can end up taking unwanted risk, even though your broker's platform might suggest otherwise. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.